What is up, guys? It is D Chantilly here, and today we'll be talking about Intel. Intel is a huge and very well-known company slash stock. It's one of the Dow 30 stocks, it's in the S&P 500, and it's one of the NASDAQ 100 stocks. And yesterday, or July 23rd, 2020, it reported its second quarter earnings. And here they are. Revenue came in at $19.7 billion, up 20% year over year. Operating income came in at $5.7 billion, up 23%. And earnings per share came in at $1.19, up 29%. Or on an adjusted basis, came in at $1.23 per share, up 16%. So the top, middle, and bottom line are very good. And just so you know, I personally refer to the operating income as the middle line because it's just kind of in the middle. It's under gross, but it's before the net income and all that stuff. So I just kind of personally refer to it as the middle line. So I just want to let you know where my thought process is there. And then you have gross margins were down 6.6 percentage points to 53.3%. Research and development and mergers and acquisitions were down 6% to $4.8 billion. Data-centric revenue was up 34% year over year. Data Center Group, or DCG, was up 43% year over year, bringing in $7.1 billion. The Internet of Things was down 32% year over year, bringing in $670 million. Mobileye, which is a leading supplier, and I'm reading this off from, this is a quote, a leading supplier of software that enables advanced driver assistance systems, or ADS, ADAS, ADAS, with over 25 automaking partners. And then end quote. And some of these partners include BMW and Robinhood darling Neo. But Mobileye's revenue was down 27% to $146 million. And we're going to talk more about Mobileye in just a moment. And then you have Non-Volatile Memory Solutions Group, or NSG. And that grew 76% to $1.7 billion. And Intel stated that their portfolio of 5G network infrastructure gained customer momentum, most notably the 10 nanometer based Intel Atom P5900 for wireless base stations. Programmable Solutions Group, or PSG, and there's a lot of things I don't like about companies that report earnings, but with Intel, if it can be abbreviated, it will be abbreviated, and I found that to be interesting. Sorry for the sidebar. But PSG was up 2% to $501 million. PC-centric revenue was up 7% to $9.5 billion. So overall, it seems like a good report, right? What went wrong? Because the stock is getting absolutely killed. It was destroyed in the pre-market, and it's getting hammered as I'm recording this video. And so let's take a look at it. Let's start with the guidance for Q3. Revenue of $18.2 billion, EPS of $1.02 per share, and $1.10 per share non-GAAP. And so the revenue was above analyst expectations of $17.9 billion, but the EPS was below analyst expectations of $1.14 a share. And it's not quite what people were hoping for, but it's not the reason that the stock is getting killed, in my opinion, because it's not that big of a miss on the bottom line. The big reason is the fact that the company announced that it is delaying its 7 nanometer chips until late 2022 or early 2023. And this is bad because they're falling behind. Competitors like AMD already have their 7 nanometer Zen 2 on the market, and they're planning for their 7 nanometer Zen 3 and 5 nanometer Zen 4 chips to be on the market by 2022. Samsung has also announced production of their 7 nanometer chips back in February of this year. And so this is really bad for Intel. Intel is falling behind. And as a result, they're going to have to play catch up. And so it's going to be interesting to see how this goes along. And are they going to be able to announce that they're ahead of schedule in a couple of months, maybe next quarter or two? We'll wait. We have to wait and see. And so why am I still interested in this stock? Why am I still interested in Intel? So let me explain why. They resumed giving full-year guidance, and it's better than expected. Revenue of $75 billion versus $73.86. Earnings per share of $4.85 a share versus $4.81. The cash flow of $17.5 billion is still strong. The company still has $19.7 billion left in its stock repurchase program, meaning they're going to be buying right alongside me. And so why is this good? There's been a lot of negativity surrounding stock repurchases recently, but that's if you do it irresponsibly. A lot of companies borrowed money to repurchase shares. I don't believe Intel is borrowing money to repurchase their shares, and they've been selective about when they do it. A company, in theory, should repurchase shares when they feel that the value of their business or the value of their shares are undervalued. And Intel has been selective about when they buy shares, and so that's a positive. But never buy into a company because they have a share repurchase program. That's not the main reason I'm doing this. It's just one of the reasons. Never buy because there's a share repurchase program. Make sure it's a good company. And so now let's get into the business. The DCG numbers were encouraging, and I expect that will continue in an upward trend. And then you have the Mobileye, which is partaking in the future of automobiles and transit. And it's a very good long-term play for this company, and I think it'll provide a lot of benefit down the road. And then you have the addition of MOVEit, which will prove to be very valuable, and we'll talk about that in just a second. Then you have NSG, or memory. That will continue to see increased demand as 5G products begin to roll out and hit the market, in conjunction with more people working from home on an extended/permanent basis. And then another reason is a safe and healthy dividend. It's yielding about 2.5%. The dividend is not in jeopardy. The company has plenty of cash to continue to pay out that dividend. They may not increase it, but they do have the money to continue to pay out that dividend, so it is safe. Finally, let's circle back to Mobileye and the acquisition of MOVEit, because I think Mobileye is going to be very important for Intel going forward. And so Intel acquired MOVEit for $900 million. Intel was also an investor in MOVEit, leading its Series D round. And Mobileye is known for its app that provides public transit and navigation data. And when I went on its website just to see how it works, I really liked its functionality. And I could see myself using it to find my way around cities that I'm unfamiliar with. But not only is the app useful, but the data and technology that it has can be very big for Intel going forward, especially for Mobileye. And according to Business Wire, the addition of MOVEit brings Intel's Mobileye closer to achieving its plan to become a complete mobility provider, including robo-taxi services, which is forecasted to be an estimated $160 billion opportunity by 2030. So the acquisition of MOVEit will integrate its technology into what Mobileye is trying to do. So it's not only a useful app, but they'll be able to integrate that technology into their robo-taxis so that they can navigate themselves around cities and areas. And so that's really big for me, and I'm really excited to see how that goes for Intel, and that's one of the reasons that I'm very interested in picking up some Intel shares. Let me know what you guys think down in the comment section below. What do you think of this earnings report? Do you think the stock deserves to be down about 15%? Let me know what you think down in the comment section below. See you there.